Welcome to the Explainer. Today, we're diving into the Starbucks stock chart, and believe me, it's telling a pretty wild story right now. A real battle between the buyers and the sellers. So let's start with this number, $85.12. That's where Starbucks stock closed recently. But honestly, that's just a number. What everyone really wants to know is, where's it going next? So, is it going up or is it going down? Well, to figure that out, we're digging into a technical analysis report that is telling two completely different stories at the exact same time. It's a classic tug of war, and we're going to look at both sides of the rope. All right, so before we get into who's pulling harder on the rope, let's get the lay of the land. What's the overall environment for Starbucks stock looking like these days? Well, the report is crystal clear on this one. The main long-term trend is a bear market. Simply put, that means the stock has been heading south for a while now. The sellers, they've definitely been in control. And here's a perfect picture of what that looks like. The current price is sitting around $85, well below its 200-day moving average, which is up over 89. You can think of that 200-day average as a kind of long-term report card for the stock. And trading this far below it is not a good grade. And get this, if you zoom out and look at the entire past year, the stock is just hanging out in the bottom quarter of its price range. This just hammers home that bigger picture we're seeing of bearish pressure. Okay, so let's grab the rope on one side, the bear side. What are the specific signals that are really pulling this stock down? This is the argument for selling. All right, we've got a technical sounding name here, the ADOSC oscillator. Don't worry about the name. What it does is super simple. It's basically a money tracker. It tells us if cash is flowing into the stock or heading for the exits. And whoa, the answer it gives is, well, it's not subtle. The value is a massively negative number. That is a huge red flag showing that sellers are still hitting that sell button hard. Money is walking out the door. And it's not the only indicator saying this. Next up, we have something called on-balance volume, or OBV for short. Think of this one as a referee, trying to figure out which team, the buyers or the sellers, is playing more aggressively. And yep, just like our last indicator, the OBV is pointing straight down. That downward slope is basically shouting that the sellers are pushing harder than the buyers, which just adds even more weight to the bear side of the rope. Okay, so long-term downtrend, money flowing out, aggressive sellers sounds like a slam dunk sell case, right? You'd think so, but hold on. Because this is where the plot thickens. This is where the other team starts pulling back. Now, this is what makes this whole situation so fascinating. There's a really strong counter-argument building on the other side of the rope. We're seeing some pretty serious signs that this whole downward slide might be getting tired. The star player for the bulls here is an indicator called the StochRSI. And the best way to think about it is like a rubber band. If you stretch a rubber band too far in one direction, eventually it's got to snap back, right? Well, that's exactly what the StochRSI looks for. And right now, that rubber band is stretched tight. The reading is way, way down at just 5.34. In technical speak, that's called oversold territory, and it's basically screaming that the sellers might have just run out of gas. In fact, the report is really direct about this. It doesn't hedge. It straight up calls this situation a potential short-term buy signal. This is probably the single biggest piece of evidence that the bulls are still in this fight. And they've got a little backup, too. Another indicator, the MACD, is just starting to poke its head into positive territory. Now, it's not a huge, roaring signal, but it's another little nudge, another hint that momentum could finally be turning. So let's recap, right? On one side, we've got the bears pulling with all their might thanks to a long-term downtrend and heavy selling. On the other side, the bulls are digging their heels in, pointing to this massive oversold signal. So who wins? What's the final call from the analysis? And the verdict is a draw, a complete stalemate. The report's conclusion is neutral, or wait and see. It's like both sides are pulling so hard that the rope is just not moving. These powerful, conflicting signals are effectively canceling each other out. And you know what's crazy? A number-crunching model backs this up perfectly. It ran the numbers and said the fair value for the stock should be about $84.91. The actual price, $85.12. I mean, it's trading almost exactly where the math says it should be. It's perfectly balanced. So what now? What do we actually watch for to see who wins this thing? Well, the report gives us the lines in the sand. Think of it like a ceiling and a floor. If the price can break through that ceiling at 86.15, that's a great sign the bulls are starting to win. But if it drops through the floor at 84.45, the bears have probably won this round. And this all leaves us with one final thought. We've just seen a market where strong, valid signals are pointing in completely opposite directions. And it makes you wonder, when the data itself is locked in a tug of war, is the smartest move maybe no move at all? Perhaps the real insight here is just the value of patience.